Hello, and welcome to Dividend Learning Channel. Today we will be analyzing Pfizer that saw its fortune skyrocket during the COVID era, but has been struggling to reach the same heights these days. Dividend yield is currently sitting at 6.77% and has really got the attention of dividend investors. Is this a classic example of dividend yield trap, or is the company undervalued? This is what we will clarify in this video, and we'll check 10 key metrics to assess if Pfizer is a buy at current levels. All-time high price for Pfizer was around $61 during December 2021, but is currently trading below $25. To put things into perspective, current share price is at the same levels it was in 2004 and also 2014. Before we jump into the profit and loss, please hit that subscribe button as it really helps the channel grow. First metric on our list is revenue and the ability of the company to grow it. 2021 and 2022 were abnormal years as revenue has doubled from previous years due to COVID pandemic. When normality was restored, company had a higher revenue than pre-COVID levels in 2023. COVID products still generate a large portion of the revenue of the company. There was growth in revenue for the last year, but Q3 revenue was extremely good for the company. So if there was a jump in revenue, why didn't the share price go up? Company has recognized some one-time profits in Q3 of 2024, so the increase in revenue was not what it seems. Hence, Wall Street was not so impressed with the increased revenue and kept share price at the same levels. Revenue was more or less the same from 2013 until 2019, so the company does not meet our 3 to 5% increase in revenue per year. Cost of sales has been down by $4.9 billion. But again, here the decrease is primarily driven by a non-cash charge of $5.6 billion recorded in Q3 of 2023. Company has announced last few months plans to reduce expenses. We are looking for an operating margin of minimum 15%. The 5-year average operating margin is 22%, while the lowest margin in the last 3 quarters was 22%. Earnings per share have been also in decline for the last 5 years again due to the COVID abnormal levels. For the last 4 quarters, company was able to beat EPS estimations consistently, which can be considered as positive. Earnings per share are expected, though, to be lower than the current level for 2 of the next 4 quarters. Moving forward, it is important to check the return on investment, as it shows how well the money invested has performed. We are looking for a minimum 7% return for the 5-year average period. Company has a 10.4% average and has outperformed industry average on all effectiveness metrics. In 2019, company had an 8% return, while for the trailing 12 months, the percentage is 2.39. Would give a pass rate for EPS, as the company historically had an above 7% return. Let's see if the balance sheet of the company is strong, starting with cash and short-term investments versus debt. Cash and short-term investments are lower than pre-COVID levels, while the total debt is higher. Company has reduced debt by around $4 billion in Q3 of 2024, which is something positive. Debt-to-equity ratio is 0.72, well below the threshold of 1 we are looking for. We are looking for companies that increase shareholders' value, and one way of doing this is through share buybacks. Left column shows outstanding shares since 2011. Pfizer was buying back shares from 2011 until 2020, but increased numbers of shares in 2021 and 2022, then did some buybacks in 2023. Last few quarters, the picture looks like a mixed bag, as it has both increases and decreases. Company has announced that it does not expect to buy back shares in the next quarter. We are now entering territory where it has more relevance as to how sustainable is the dividend of Pfizer. Dividend yield at current prices is 6.77%. This yield is well above the industry and index average. What's not to like, right? Companies that pay a high dividend yield are usually dividend traps or undervalued. So how safe is the dividend of Pfizer? In the latest earnings report, management stated that it is looking to maintain and grow the dividends as it wants to return value to shareholders. This is a good sign that shows the intention of the management, but eventually they might be forced to reduce it if numbers don't add up. Pfizer has halved their dividend in 2009 and will probably do it again if they have to. Since 2013, dividend payouts have been well below free cash flow generated by the company. Operating and free cash flow in 2023 has been well below the pre-COVID levels. In 2023, free cash flow was around 50% of dividends. In trailing 12 months, dividends were $9.5 billion, while free cash flow was $8.2 billion. If the company does not improve numbers across the board, with current performance, the level of dividends is not sustainable. Dividend growth is something we like, and we are looking for a 5-year average increase around 7%. 1-year growth rate is 2.45%. That is lower than our target, but also lower than the historical average level of inflation. 5-year average dividend growth is 3.39%, which is again lower our desired levels. It is difficult to assess the current picture of the company, as the COVID era was an abnormal event that disrupted normality and also the numbers of the company. Usually after such big and one-off events, companies go through a tough phase of adaptation and restructuring. This is true for Pfizer, and probably the market has discounted the value of the company more than it should. Warren Buffett famously said, "Be fearful when others are greedy, and be greedy when others are fearful." Pfizer has acquired Seagen at the end of 2023. Seagen is one of the largest ever investments of Pfizer and is a company producing drugs to cure cancer. Results of Seagen are expected to improve and boost top and bottom line numbers. Pfizer has several new drugs that are on the pipeline of approval and are expected to boost numbers once they are out on the market. Company announced in 23 a plan to cut costs by $4 billion, and in 24 announced another plan for a further cost-cutting for $1.5 billion. Majority of changes will be recorded this year, with the actual outlays expected to be in 2025 and 2026. Zacks is giving a rating of 2 to Pfizer, which translated to buy. Seeking Alpha states that Wall Street rating of the company is 3.65, which is again a buy. Average price target is $32.55, which is an upside of more than 31% from current price. Company meets just 5 of the 10 metrics we have analyzed, so normally I wouldn't buy it. I like the fact that company underwent a one-off event that shocked the company. It used the COVID profits to buy Seagen that will improve numbers going forward. I am also trusting the Wall Street experts and people at Zacks that the company is a buy. This might not be the best performing stock in the next 2 to 3 years. I am aware of the current problems, but I consider Pfizer as my current dividend cow. Above the market dividends received will be used to buy other companies with better growth prospects. Today we will be analyzing Pfizer that saw its fortune skyrocket during the COVID era. Dividend yield is currently sitting at 6.77%. Is this a classic example of dividend yield trap, or is the company undervalued? This is what we will clarify in this video, and we'll check 10 key metrics to assess if Pfizer is a buy at current levels.